Hello traders, you're welcome to this video. In this video, we are going to be looking at moving averages that you can use on the 1 minute chart. Basically, we're going to be looking at a strategy of moving averages on for or moving a strategy for moving averages for the 1 minute chart. Sorry about that. Okay, so first of all, we need to understand moving averages. And by doing that, we're just going to be differentiating the two main moving averages, which are the simple moving averages and exponential moving averages. Now, as for the simple moving averages, it's calculated by averaging the price over a specific number of periods. For example, if you have a moving average with period 20, it shows that the moving average is averaging the price over 20 periods. Okay, because a 20 period SMA sums the last 20 closing prices. If you are using apply to close, it sums the last closing prices and divides by 20. It gives equal weight to all prices. Okay, then as for the exponential, you can see how the 20 SMA looks like. The 20 SMA, right? Now, as for the exponential, it gives more weight to recent prices, making it more responsive to new information. Now, the formula incorporates a multiplier, which is why it reacts quicker to price changes. It's calculated using a more complex formula, which can be found in trading software. So we can see how the 20 EMA looks like. You can see it responds to our prices faster. Okay. Now, why do you use moving averages? One of the reasons why we use moving averages is for trend identification. Moving averages smooth out price data to help us identify trends over a specific time frame. Now, this is the 1 minute time frame. You can see that even on the 1 minute time frame, you can identify the trend on that time frame. Short-term trend. You can see when price is trading above the moving average, it indicates a bullish trend. When price is trading below it, it indicates a bearish trend. And then when you have a crossover, when you have price cross over the moving average, it indicates a buy signal. When you have price cross above the moving average is buy signal. When price cross below the moving average is a sell signal. Okay. Now, how do you interpret these signals? In an uptrend, like I already said, price will be trading above the moving average. In a downtrend, price will be trading below the moving average. Okay. And you can also decide to use crossover strategy for this time frame. The crossover strategy of the moving average is one of the common strategies usually used. Just going to use the 9 period in addition to the 20 that we already added. So when you have the shorter period moving average crossover the higher period, it indicates a signal. So in this case, when you have the bearish crossover, it indicates a sell signal. When you have a bullish crossover, it indicates a buy signal. That's when the 9 EMA crosses below the 20 EMA is a sell signal. When the 9 EMA crosses above the 20 EMA is a buy signal. So for this crossover, you can sell around here. You can set your stop loss above the swing high, the previous swing high. Take profit can be at the nearest support zone. For your buy, you can enter after the crossover. Set your stop loss below the previous swing low. Take profit could be at the nearest resistance zone. Perhaps somewhere around here. Okay. All right. So it's a very easy strategy, and on the 1 minute, it means that you're obviously scalping. So you want to take advantage of every price move. So whenever you have the price breaking below the EMA, if you were already in a buy trade, you will want to exit immediately. And then when you have a crossover, enter quickly. You can also confirm with trend lines. You can also use other indicators, RSI, stochastics, MACD, and the rest of them for extra confirmation. Okay, and then make sure you use support and resistance lines so you can identify potential reversal zones, potential continuation zones, potential zones for entry and exit that will add as extra confirmation to the signals given to you by the moving averages. Okay. Now, it's always important to use stop losses. Okay, they help protect your trades by, preventing price from going far against you. In case of if maybe your analysis had a fault or something, or market just did what it wanted to do against you, you will not lose so much because your stop loss will exit the trade when it gets to your level of stop loss that you set. So if you are risking for example, 1 to 2% of your account, and you set your stop loss at 2% of your account, when price gets there, you end up losing only 2% of your account. So it's important to use stop losses. And then in terms of position sizing, only risk a small percentage of your trading capital. Okay, that's the reason why some traders prefer to risk maximum of 3% of their capital in one trade. Okay, so you can even consider using a smaller percentage based on your risk tolerance. Okay, so basically using moving averages on a 1 minute chart can significantly enhance your trading strategy. This is for scalpers. They help the moving averages identify trends, provide entry and exit signals, and can improve decision making in fast-paced markets. Okay, so you might want to practice using these strategies on a demo account to gain confidence before applying them to live trading. Okay, so I hope you found this video insightful. Kindly like and subscribe for more trading insights, and don't forget to hit the notification bell so that you don't miss out on more trading videos. Okay, thanks for watching. Happy trading.